Markets move when people move together, and understanding that early is the real advantage. When we move together, we shape outcomes, build wealth, and secure a safer future. The US equity market retreated today with the S&P 500 down over 0.5%, led by losses in technology and consumer discretionary sectors. Rising Treasury yields pressured growth stocks, reversing recent momentum in big tech. The Nasdaq Composite underperformed, reflecting investor caution ahead of upcoming inflation data. Expect continued volatility in tech and growth sectors as bond yields remain elevated. Defensive sectors may attract more attention, especially if inflation prints surprise to the upside. Federal Reserve officials reiterated a hawkish stance today, signalling the possibility of more aggressive rate hikes to combat persistent inflation. This pushed the 10-year Treasury yield above 4.1%, its highest level in over a decade, intensifying pressure on rate-sensitive assets. Higher yields are likely to keep weighing on growth stocks and sectors dependent on cheap financing. Investors should consider the impact on valuations and favour sectors with pricing power. Energy and utilities sectors outperformed as oil prices stabilised around $90 a barrel amid geopolitical tensions, and investors sought safer income streams. Utilities benefited from their defensive characteristics and steady dividends in a risk-off environment. Energy and utilities may continue to outperform if volatility persists and inflation remains elevated. These sectors offer relative safety and income in uncertain markets. Technology stocks declined notably as investors reassessed valuations in light of rising interest rates. Semiconductor and software companies faced selling pressure, reflecting concerns over margin compression and slower growth prospects in a tighter monetary environment. Tech sector weakness could persist while yields remain elevated. Focus on companies with strong cash flows and pricing power to weather interest rate headwinds. Chevron demonstrated resilience amid broader market weakness, supported by stable oil prices and strong cash flow generation. The company's robust dividend and capital discipline are attracting investor interest in a volatile environment. CVX is positioned well to benefit from sustained energy demand and pricing power. It may serve as a defensive value play amid ongoing equity market volatility. Nvidia shares fell sharply, pressured by concerns over slowing demand for chips amid economic uncertainty and inventory corrections. The sell-off reflects broader sector rotation away from high-growth technology names sensitive to interest rates. Semiconductor stocks like NVDA may face continued headwinds near term. Investors should watch for signs of stabilization in demand before considering re-entry. Market sentiment shifted decisively toward risk-off as hawkish central bank rhetoric and elevated bond yields heightened uncertainty. Investors rotated out of growth and cyclicals into defensives and energy, reflecting increased caution ahead of key inflation data releases. Expect continued choppiness, with risk aversion likely to persist until inflation signals clear easing. Defensive positioning and quality income names should attract inflows. Inflation remains sticky despite recent tightening, prompting Fed officials to maintain a hawkish tone. Upcoming CPI and PPI data will be critical in shaping near-term rate expectations and market positioning. Close monitoring of inflation data is essential. A surprise higher print could trigger further volatility, while signs of easing may provide relief for equities. Highest conviction setup, CVX. Chevron offers a compelling combination of stable cash flow, attractive dividend yield, and exposure to steady oil prices amid geopolitical uncertainties. Its disciplined capital allocation and defensive sector positioning make it a strong candidate to outperform in a risk-off environment. CVX is likely to hold support near current levels with potential for modest gains as energy prices stabilise. Continued risk aversion should keep investor interest focused on reliable income generators like Chevron. If this breaks, a sharp decline in oil prices below $80 or geopolitical de-escalation that undermines energy premiums could weaken CVX's outlook and reduce its defensive appeal. What happens next? Markets remain volatile with a cautious tone prevailing. Inflation data may confirm persistent price pressures, keeping yields elevated and favouring defensive sectors and value names. Tech and growth stocks may continue to struggle near term. Inflation surprises to the upside or more aggressive Fed guidance could trigger sharper equity sell-offs and bond market volatility. Conversely, a significant easing in inflation could spark a relief rally, especially in growth sectors. Tomorrow watch upcoming CPI and PPI inflation reports, Fed speeches for updated policy guidance, 10-year Treasury yield movements above 4.2%, oil price fluctuations near $90 support, tech earnings updates for demand signals, geopolitical developments impacting energy markets. Markets move when people move together, and understanding that early is the real advantage. When we move together, we shape outcomes, build wealth, and secure a safer future. Real wealth starts with discipline, health, and strong relationships. Take care of yourself. Take care of the people you love. Stay focused, keep learning, and stay informed. Until next time.